Good afternoon. I'm Julia Coakley, and on behalf of the MGAA, I'd like to welcome you today to our market briefing, which is being delivered by CRIF. Before handing over to our presenter, I'd like to run through a few housekeeping points. Please ensure your microphone and your camera is off. And if you'd like to ask a question, please drop this into the chat box, which will be answered during the Q&A session. If we don't have time to answer your question, Mattia will be delighted to answer your questions post-event. The MGA's Programme of Learning and Insights has been accredited by the Chartered Insurance Institute for the quality of content and supporting materials, with CPD hours applicable if this is relevant to your ongoing professional development. The recording of this briefing will be available on our website and MGA YouTube channel, and we will also be rescheduling this event to be delivered again at a later date. Finally, you'll see a feedback survey. Please do take time to complete this, which should take no more than 2 minutes of your time and does allow the MGAA to deliver the best quality events. So just to remind you, if you would very kindly have your microphone and cameras off, we would be most grateful. So today's briefing, Transforming ESG Challenges into Opportunities, Enhancing Profitability in Commercial Insurance, is being delivered by Mattia Bongini, Data Science Manager at CRIF. Mattia has over a decade of experience in advanced analytics and machine learning and leads team developing solutions for insurance and banking in areas such as risk-based pricing, fraud detection and banking, and sustainability. Before joining CRIF, he held roles at the European Central Bank and earned a PhD in applied mathematics from the Technical University of Munich. So Mattia, may I hand over to you?
Thank you very much, Julie. So let's go through the learning objectives of today's session. So at the end of the session, you who are attending this event will be able to explain how to integrate a sustainability assessment into the commercial underwriting process without involving the client in a tedious ESG questionnaire. As a second objective, you will be able to outline which ESG data and key indicators are accessible and how to determine their correlation with the insurance risk based on real case studies. And finally, you will be able to explain how to improve loss ratio by underwriting more sustainable and ESG compliant businesses. So these will be the first, let's say, the most important points to deliver today. And they will be the actual items of our agenda. So let's start to understand together how to integrate a sustainability assessment into commercial underwriting. I would like to start with a survey that CRIF has done together with Insurance Post regarding sustainability teams. And in this survey, CRIF and Insurance Post have asked to commercial insurances how embedded is ESG data in the organization, product, service development. The findings were that actually ESG data is at least partially embedded by most of insurance companies. So this is already good news because these kind of data are paramount in the current scenario, and and it is important to exploit them to draw correct conclusions before underwriting. However, if we go a bit deeper and ask which kind of data is actually measured, let's say, within the ESG data, we see that actually most of insurance companies are focusing their let's say, attention on physical risk, either related to floods, storms and hurricanes, heat or cold waves, landslide or others. The physical risk is at the center of their evaluations. Teams like carbon emissions and other drivers like the disruption caused by transition into a greener economy or external accreditations are way less let's say, way less distributed as KPIs to be monitored. And this is actually a very important part to understand, because this all boils down to what is called the double materiality assessment. That is the fact that let's say businesses and the world, let's say the economy, the environment, are all intertwined in a double way. On one side, of course, there is the impact that as a company has on society and the environment, and these kind of impact can be measured in terms of how much the company emits, so greenhouse gases emissions, how the company exploits work from people, so themes like modern slavery, which are particularly let's say assessed in the UK regulatory environment. And so how basically what is the inside out impact of the company onto the world. On the other side, there is dependency, that is mainly physical risk, and that, let's say, the outside in effect of the environment and society on the company. This is, let's say, actually the bread and butter actually of insurance companies, as we have seen before. So that's why in the rest of the webinar, we will be focusing on how to measure the impact of a company on the environment and society, and how to monitor and embed this kind of quantification into underwriting. Of course, this on paper seems to be, let's say, easy, but as you may have noticed if you have tried to understand, let's say, to quantify this kind of behavior on the kind of companies that you are underwriting, this is actually a big issue, because the kind of data that would be needed to carry out such an activity are very, let's say, are not so much available. The main issue is that this kind of data, yes, are available, but they are published in sustainability reports, which only are available for very few large companies. So they are kind of, and they're also, let's say, subject to greenwashing. So it's the kind of data that are available are few and at least dubious in terms of what they convey. So this means that the data on SMEs is actually even rarer. And obtaining reliable data on SMEs usually is done through questionnaires. However, as you may understand, there is a lack of incentives or let's say from SME side to fill out those questionnaires. Or there could be channels issues, in the sense that brokers with which you are working with may be not so keen on submitting those questionnaires, because they may become an impediment, let's say, for the company. And so here getting data from questionnaire is very hard, even because questionnaires are not available real time, as actually it would be necessary if we would like to use this kind of data into pricing models. So the responsiveness of this data is also a matter. That's why everything points towards statistical data, basically, to retrieve this kind of information. But however, you may know, you may have noticed that there is no single coherent data source for all ESG data points that would be interesting and needed for this kind of analysis. needless to say that, moreover, this kind of data is also very dishomogeneous if we talk about different countries. So there is also for large insurance groups the issue of having a data structure, let's say, which is coherent at a group level. So how then can this kind of problem be broken down in order to be solved? But since we are talking about the underwriting process, let's start from the typical data which are available from companies at the underwriting stage. The typical available data at this point are usually registration number, if the company is big enough, let's say, to be registered to Companies House, and potentially its SIC code, so the economic sector of activity code, and the address of the headquarters. These are, let's say, the typical kind of information we have at this stage. Of course, I am assuming that the insurance company is willing to collect this kind of data, because this is, of course, the let's say, the kind of condition. How we can use this kind of data in order to retrieve ESG data, ESG information. So registration number, for instance, can be used to retrieve business information from Companies House, which of course, it's they are not ESG data in a broad sense, but they can be used, as we will see in a couple of slides, to, let's say, derive ESG indicators. Or they can use the registration number to check the presence inside third-party databases which are connected to sustainability issues, like, for instance, the health and safety executive database for breaches, or other databases which you will see in the next slide. The SIC code instead can be used to compute proxy sectoral ESG behavior by looking at databases, potentially not only national, so provided by the Office for National Statistics, but also supranational, like Exio-based academical one, and so on. To compute this kind of information, especially regarding emissions and employee relationship. While instead, the address of the headquarters can be used to check for geographical factors, like the presence of natural areas near productive sites, and so on. Even though we of course know that the address is mainly relevant, of course, for physical risk evaluation, which is not, let's say, part of this webinar. And again, here there are several open and proprietary databases which can be used to retrieve this kind of information. But let's start from the kind of data that we can be used from by looking at the registration number. So here we report some of the examples which are relevant from an ESG point of view. I start from Companies House. As I was saying, this is mainly a vehicle for what comes later. So Companies House, as you know, is the official registrar of companies in the UK, and can be used to retrieve business information like financial statements, director information, and so on. So we will see in a minute how we can employ this information. Modern slavery is covered by several databases provided by the UK government, which are open. So this kind of databases can be used to understand if a company which is subject to the Modern Slavery Act, if this company has produced all the necessary documentation to fulfill this obligation. Again, I already cited HSE breaches databases and convictions databases, which are providing a lot of negative information for companies who are actually breaching, let's say, which are breaching their work safety regulations. And then, of course, there are also international databases, like the one provided by the Business and Human Rights Resource Center and the OECD, which contain allegations, instances of cases, and so on, which let's say, tell us if a company is suspect to breach human rights laws. So again, negative information which can be crucial in determining if the company is sustainable or not from a social point of view. But, as I was saying, business information play a crucial role in this because they can be employed to compute very easily, actually, some governance indicators which can be readily used for this kind of use case. For instance, from the information that can be retrieved from business information, one can compute, for instance, the average age of the members of the board, the gender gap of the member of the board, of course, the gender of the chief executive officer, which is again a signal of gender equality within the company. But if there are potential family ties among members, which is again a theme regarding transparency and accountability within the board. Also, the number of corporate offices is kind of relevant, of course, discounting for the size of the company, because companies with larger boards tend to be run, let's say, in a more accountable way. And lastly, for instance, a measure of locality. So what is the percentage of members of the board living close to the headquarters? This is particularly important for very polluting companies, because if a company is active, let's say, in a sector which may pollute the environment, if board members live close to those productive sites, it means that they are usually taking care of where they live, and so there should be a higher probability of them not breaching laws in terms of emission and pollution. These are just examples, of course, of indicators that can be computed. Many more can be computed by mixing business information, open statistical data, and analytical models. And all this kind of information can be computed without the need to interact directly with the company to underwrite, because we are using open information and, of course, statistical models to infer the environmental, social, and governance behavior of the company. So, for instance, with analytical models, we can estimate which kind of emissions, divided between scope 1, 2, and 3, a company has, based only on this kind of open information. Of course, in case the company has a published figure for greenhouse gases emission, this is the one that should be employed, for instance, for reporting. But here the scope is a little bit different, as I was saying. It's to understand and quantify what is the environmental, social, and governance behavior at underwriting. So even, let's say, a rough estimation of the ESG behavior matters. And so basically, these are just examples that I was saying, illustrative examples of KPIs which can be measured using all open databases and analytics. So let's wrap up a little bit how the underwriting process works actually from underwriting data to ESG data. Could work, let's say. Of course, we said that we start from the available underwriting data, which is registration number, economic sector of activity, and the address of the headquarters. And what we can do as a second stage is to check whether the registration number is inside third-party databases, like the one we have seen of HSE and so on. Of course, if in case the registration number is not available, this cannot be done. Like we cannot check and retrieve business information from company's house if we don't have the registration number. But, however, if we have the economic sector of activity and the address, we can still compute several analytical ESG indicators through analytics and and open databases. So in the end, we will still be able to compute at least some of the indicators we have seen before. So this, in a nutshell, is a potential, let's say, process, enrichment process of ESG data starting from underwriting, using really the minimum information available. What are the pros and the cons of this approach? Of course, let's start from the pros. As you can understand, this process is reasonably fast, in the sense that the computation of this kind of indicators can be done quite quickly. Let's say if we are a little bit clever, let's say, with data management and the computation of the KPIs. Moreover, there is no limitation regarding coverage, because beside the availability of underwriting data, we can compute this kind of indicators basically on each company which we have at underwriting. The other advantage is that this approach is authoritative, in the sense that we rely on authoritative sources and methodologies to compute those KPIs. Of course, for instance, when we develop the greenhouse gases emission estimation model, we have to be sure that we comply with what the PCAF says regarding this issue, because they are the authoritative sources regarding greenhouse gases emissions, and this should be true also for the other KPIs. Lastly, which is the most important part, and I will say highlight this point even later, this kind of methodology is give rise, let's say, to a statistically significant ESG database. So the data that we have computed can be employed to perform statistical analysis, and this is extremely relevant for the next slides. Before moving on, of course, let me mention also the cons of this approach. First of all, I mean, I made no mystery in what I'm saying right now. Before, several indicators will be statistical proxies, of course, like we have said with greenhouse gases emissions. This is a limitation, of course. This is no reporting, this is underwriting, the use case is different, so we have to keep this in mind. Of course, for an insurance company to establish all this procedure, there is a relevant initial investment to create this pipeline and to develop the individual statistical models which are necessary for carrying out this activity. And this kind of pipeline needs to be maintained periodically, because the underlying databases refresh themselves. So you have to refresh the database of greenhouse gases emission coefficients and so on. And lastly, you need vertical ESG modeling competencies within your organization, which is usually not always available. So keeping in mind the cons that I've said right now, please remember the last point of the pros that I said before, that this process enables the statistical analysis of ESG data with respect to insurance risk. Because this is exactly the second point of our agenda, where we try to understand together how to measure the correlation between ESG data and insurance risk. So, in the first part, we have devised a statistically significant way to enrich ESG data. And now we want to check whether the indicators of ESG performance that we have computed are correlated and predictive, therefore, of insurance risk. So how do we start? So first of all, there is that enrichment phase, in the sense that we have developed an enrichment pipeline, so we can input into this pipeline the entire commercial portfolio of the insurance company and enrich all the ESG indicators on all the companies in the portfolio, using the registration number, the economic sector of activity, and the address of the headquarters. Then, once we have this, let's call it flat table of companies and ESG KPIs, we can do a correlation analysis for each line of business. What do we do? We have to create a short list of KPIs which are which are correlated with insurance risk in terms of loss ratio, claims frequency, burning cost. It depends, of course, on what is the target of the analysis. In this step, of course, we can combine advanced machine learning techniques like random forest, feature selection, and so on, together with traditional methods like Pearson or Spearman correlation, you name it. Combining all these techniques, we can have, let's say, in the end, a short list of KPIs which are highly correlated with insurance risk, if there are, of course, because, but let's say here I'm spoiling a bit what comes next. There are, so the short list will be will have at least some KPIs. Of course, this kind of step is necessary in order to avoid univariate relationship between each KPI and the risk indicators. Finally, this is a very important step. We don't have to keep KPIs into the short list only if they are correlated, because it is very important that this kind of KPIs maintain their interpretation in ESG terms, in the sense that if greenhouse gases emissions are increasing for a company, my expectation is that this kind of company will be much riskier than a company that has low greenhouse gases emissions. So the expected relationship between greenhouse gases emissions and insurance risk should be, let's say, increasing. So the more greenhouse gases emission I have, the more risk I should have. Instead inclusiveness. So if I measure, let's say, how inclusive a company is in terms, for instance, of gender gap in the board, I should see that if I have a higher gender gap, I should have much more ESG adequacy, let's say. If I should have much less risk. So in this sense, we should maintain only ESG KPIs which are correlated with insurance risk, but also coherent with their interpretation. So as this is the spoiler I was let's say advertising before. Evidences from real cases actually suggest that this kind of indicators that we have created in the first part of the pipeline are indeed correlated with insurance risk. And let me stress again that we can do this kind of analysis because we have enabled, let's say, a statistically significant database which let us quantify this kind of KPIs. Otherwise, if we would rely, for instance, only on data coming from questionnaires and sustainability reports, this kind of analysis will not be possible because data are too few to be consistent. So what we have actually witnessed from real cases, let's say, that we have encountered, is that actually a low level of greenhouse gases emissions, scope 1, in terms of intensity, is actually telling you that the company will be much less risk in terms of loss ratio by from minus 50% to minus 30% with respect to the portfolio average. And this by taking into account, for instance, we have witnessed this kind of evidence taking into account property net of nat cat. This is of course data coming from a pool of companies with which we have tested this kind of evidences. But also the presence of an ISO certification, the ISO 14001, is actually associated with the same type of behavior. So the companies who have this kind of certification will have a loss ratio which is expected to be from minus 20% to minus 10% less than portfolio average. Actually, the same is true also for social and governance indicators, and not always on the same side. Let's say not only we are witnessing, let's say, a reduction in loss ratio. For instance, if we take into account the presence of a high percentage of temporary workers, we see that actually this kind of population is expected to have from plus 25 to plus 40% of loss ratio with respect to portfolio average. So in the end, we have seen and we have tested with multiple companies that actually this seems to hold. And so this kind of analysis is actually useful in terms of explaining at least part of insurance risk. Of course, part of insurance risk, not everything, because there are, of course, other material components that affect loss ratio. But as we will see in the next part, the kind of loss, the part of the loss ratio which can be explained by all these KPIs is actually relevant. So that, let's say, the creation of a super score, let's say, of this ESG KPI is actually capable of reducing a lot the variance in actuarial models for pricing sophistication. So exactly, so we are talking about how to improve loss ratio with all this knowledge that we have acquired so far. So as you know, the last, let's say, the last stage, we are left with a short list of KPIs which are not only correlated with the chosen insurance risk, but are also coherent in terms of their ESG interpretation. Okay, this is important. Both components should be active, let's say, on every KPI of this short list. So with this shortlist, of course, we can create a model. Let's say we can synthesize all the best features of each KPI into a single superscore in order to, let's say, free degrees of freedom and create a powerful score that can be employed for pricing sophistication purposes, but also for sustainability assessment. So what we do is we do a training, first a training step, let's say, where we implement a training pipeline like a grid search for gradient boosting or parameter optimization to develop an array of models to be evaluated further with respect to specific KPIs that we might have. Then, of course, we evaluate those models and we choose the best one by selecting it, not only considering its predictive performance on the test set and its overfitting performance, but also taking into account how many KPIs we have considered, because model parsimony is very important. If the let's say the score at the end is actually coherent with sustainability assessment, this is very important. So we have to test at least a bunch of cases manually to see if the scrutiny holds. And of course, we have to validate empirically that at least it works. So in the end, we will have typically a continuous model which we can clusterized into a finite number of classes, yes, in order to enhance the monotonic relationship between the score and all the risk indicators. So typically what we do here, let's say this is purely illustrative, you can do whatever you want, but we like to use 5 classes where one, the score 1 means that the final ESG evaluation means that the company is more aligned to ESG criteria than most of the companies, while a score of 5 means that the company is less aligned. If we have done all our steps in the correct way, this is usually what we obtain, let's say, when we apply the score. So here on the left, you see the 5 classes from more aligned to less aligned. And since all the ESG KPIs have been selected in order to be correlated with insurance risk, here I consider loss ratio, but you can take claim frequency if you like, we see that actually if a company is more aligned, then we will have something like this is more or less constant in what we have seen, minus 40% of loss ratio with respect to the average of the portfolio. While instead, if the company is less aligned, so it has it is on the highest cluster of the score, the observed loss ratio is way higher. It could be up to plus 60% with respect to portfolio average. So it is kind of natural to tell you what the potential commercial action may be on these two segments. On the more aligned segment, of course, what we can do could be to decrease the commercial price or increase the discount in order to, let's say, make these kind of companies more attracted towards our insurance products, because if you decrease price, usually this is how it works with respect to demand. Instead, but how do we finance this kind of discount? Well, usually you can reinvest what you get actually from increasing price or decreasing the discounts on the less aligned class. And so in a certain way, you redistribute your incomes, let's say, by, let's say, giving a premium to those that are more aligned and penalizing those which are less aligned. In this way, you are actually trying to select better your commercial portfolio. And if you, let's say, enable, let's say, this kind of strategy, the outcome can be only one. Let's say, on one side, you will improve the loss ratio of your portfolio. Of course, if we consider, let's say, revenues to be constant, let's say, while of course you could, let's say, have constant loss ratio, but improve revenues and so on. But moreover, this is very important, you will increase your share of ESG aligned companies. And why will you be sure of this? Because if you look at the score tells you regarding these companies, you will see that actually the score tells you exactly that. Here I give you a couple of examples. Let's say these are illustrative examples, but coming again from real cases. These are two companies, let's say, which they are similar in terms of company size, which are doing activities slightly different, but let's say the kind of activity is not really telling you if this company is sustainable or not, because, for instance, company A develops and produces systems for material handling and movement, while company B, let's say, is active into the printing, coating, and processing of metallic materials. You see immediately from the ESG KPIs that we have computed for company A that the company A has very low emissions. It has an ISO 14001 certification. We could check that they got government aids for energy efficiency improvement. So on the E side, this company is exceptional, but it's also very good on the S side, where they have an health and safety certification and a high percentage of full-time employees. And on the governance side, they have several patents filed and operate in a low gender pay gap, environment. This is entirely the opposite for company B. Environmental, very bad. No ISO, no government aids, very high greenhouse gases scope 1 emission. On the social side, again, sorry, there is a mistake. No health and safety certification and low percentage of full-time employees. On the governance side, instead, high gender gap, no patents filed. In the end, the score will tell you that company A will have a very good score, likely 1, while company B will have a very bad score, likely 5. Actually, it turned out that company A was indeed also a very good company for profitability in terms, let's say, for the insurance company, while instead company B was associated with 4 claims with a very high loss ratio. So in the end, it would have been right to penalize company B at the underwriting stage because of its ESG behavior. Because as a final wrap-up, let's remember that the ESG behavior is a little bit like the behavior of a good family father in a certain sense. If a company behaves well from an ESG point of view, it is also likely to be a good client because it is a good corporate citizen. So I think we can wrap up the learning objectives and leave you room for potential questions. First of all, I will, of course, try to synthesize a little bit what we have learned with respect to the three learning objectives we have stated at the beginning. In the first, let's say, if you remember, in the first point, what we have learned is that open data sources and analytics can provide several statistically significant ESG indicators, which can be computed directly from the scanned information available at underwriting. On the second point, we have learned that since these indicators can be computed on the entire portfolio, they enable a correlation analysis with insurance risk. Experience show that many ESG indicators do indeed show such correlation, and we have given some examples which we have taken from real cases. And finally, on the third point, we have learned that mixing the best ESG indicators by means of advanced machine learning techniques leads to ESG scores which are useful both for pricing sophistication and sustainability assessment. With this, I thank you very much for your attention, and I put here some of my contacts if you would like to keep in touch, let's say, and discuss further on the topic. And I give you back the mic, Julie.
Mattia, thank you so much. That was incredibly interesting. And I think, I think we all know that there's a lot of information on the internet that, most of us haven't even ever thought of tapping into, but it really is quite incredible just how much information there is when you conduct open source research. So really appreciate that. It's a real eye-opener. I have got a couple of questions actually, if you don't mind.
Absolutely.
First, I'm not sure whether it's actually asking if you have competitors in your area, but the first question is, do you know if any company has ever implemented this approach to pricing sophistication?
Yes, absolutely yes. We have worked. We know that there are several several companies who have implemented such procedures. Like for instance, AXA is one of those, and we know because of course we have worked with them, so we and this is public knowledge, of course, what I'm saying. So we have disclosed together this kind of process, and so there are of course companies which are at the let's say at the cutting edge, let's say, of this kind of stream, and are already, let's say, reaping the benefits of this approach.
Thank you. So another question I have for you.
Yeah.
So think about the sort of size of our MGA members. Some are going to be very, very vast businesses, and some will be very much, kind of a handful of staff controlling actually quite a lot of premium. How complex is it for companies to implement pricing sophistication based on ESG factors? I think that's what the question there would be, how easy is it actually for MGAs to be able to progress something like this?
Okay, so if I get the question right, so let's say how costly it will be, let's say, from if I would put it on a monetary terms, to implement all these process in-house, basically. Well, I actually partially answered into the during the slides while mentioning the cons of this approach, because it's kind of to implement everything in-house is kind of a burden. Let's say it's kind of very kind of pricey, because you need to have vertical knowledge. You need to create ex novo pipelines and maintain them. So it's not easy. I understand. That's why what we see in the market is that insurance companies are engaging with advisory and they basically ask for support to companies which have a vertical knowledge on this kind of domain. So let's say it's usually much more a buy approach rather than a make approach in this sense. And I totally understand why, because these are not, let's say, core knowledge for insurance companies, but still they are very valuable information that can be used to gather an edge into this kind of pricing, and to be, of course, let's say, an agent for a better world, let's say, because in the end, as we have seen at in the final slides, this kind of approach really selects better ESG corporate citizens.
Thanks, Matteo. Thank you. Very comprehensive answer. Sorry, this is actually a question from myself. Have you worked, or are you aware of kind of how the FCA is progressing in terms of capturing ESG data? Have you had any engagement with the FCA, or indeed, as I say, any knowledge of what might be coming down the pipeline from the FCA's perspective?
Well, let me just say that, let's say, things in this sustainability world are moving fast. So the kind of things that may be true last month could be already not valid anymore today. So things are really moving fast. So we have seen that there are some discussions on these. We are also in talks with regulators and the UK side on these. So let's say whatever I tell you right now will probably not be valid in a month. So it's very fluid right now. So, but still, there is only one thing is constant. So that the direction is set, and the requirements will be. So for let's say that for insurance companies, it's not a matter of why or if they should do so, but it's just a matter of how, of when they have to do it. So insurance companies need to start to think about these terms, say these topics, not only from a physical risk point of view, because from the physical risk point of view, they are already, let's say, pushed by by climate change, basically, and the kind of a shift in risk within their portfolio, but they need to act also on the sustainability part, because it's really becoming one of the hot topics right now.
Yes. Thank you, Matteo. We don't have any further questions, so I will look to wind up now. But if you do have any questions, as I said, Matteo would be happy to answer these post-event. So do drop your question into the chat box, or indeed feel free. Matteo has included his contact details on the slide that you're looking at now. So do feel free to contact Matteo directly, as he would be delighted to hear from you. So we're going to wind up now. We will be sending a feedback survey, and we will be sending the slide deck of the presentation that you've just seen. Again, if you have any questions, please feel free to drop them into us or directly to Matteo. Thank you for joining us. If you did try to join earlier with the incorrect timing, once again, I do apologise. However, we will be looking to have an additional presentation from CRIF early next year, so please do look out for that. I know our members are very keen to support our supplier membership wholeheartedly. So, Matteo, thank you very much again.
Thank you.
And to our delegates, thank you for joining us.